Let's talk about inflation. Yes, Jerome Powell was indeed right. Inflation has been transitory. But in this video, we're going to talk about where it should be, how the current situation came to be, and at what cost it is being steered back to an acceptable level. I will be mostly talking about the United States, as that is where I have the most insight in, and it is the economy least affected by the war in Ukraine, as well as the pandemic that is now catching up in Asia. What I'm about to talk about is not advice of any kind. It is merely speculation based on publicly available information. The Federal Reserve has a target inflation rate of about 2%, and most economists agree that a modest amount of inflation is actually good for the economy. This is because too little inflation, or even negative inflation, aka deflation, incentivizes people to save their money. If my money will be worth more tomorrow or a year from now, I can put off some discretionary purchases to save a couple dollars. If I have money today and the thing that I want is going to cost more tomorrow or a year from now, I might as well buy it now. I think most people know what happens when there's too much inflation, but it's worth going over briefly anyway. In cases of extreme inflation, when someone in government or central banking decides to turn on the money printer and have it go brrrr for a while and let it run non-stop, the ratio of money to goods and services gets skewed a little bit too much. This causes the currency to lose its value. The eventual effect of hyperinflation is that the currency becomes essentially worthless. The people whose economy uses said currency become impoverished, and the nation itself ends up defaulting on its debts, and the international community gets a headache trying to figure out how to sort it all out in the end. The pandemic that began in 2020 shook the world economy as many nations went into partial or full lockdowns. It accelerated society's acceptance, adoption, and competency in remote work. Supply chains were initially in a whole lot of chaos. What the Federal Reserve had to deal with initially, however, was the complete shutdown of the service industry. Restaurants, theaters, gyms, everything was closed back then, and they all had to make cuts to staffing in order to keep the businesses alive. Millions of people were suddenly unemployed with either rent or mortgages they still had to pay. Unchecked, without all the stimulus checks that were going around in 2020, this may have collapsed the economy Great Depression style. Instead, we've seen a years-long reshuffling of who works where in the economy, and said economy is returning mostly to normal. With stimulus checks as well as the Payment Protection Program, aka PPP loans, the Federal Reserve was able to inject trillions of dollars into the economy while people were still figuring everything out. This greatly increased the money supply. Additionally, it also slashed its interest rate to near zero, allowing businesses to borrow money in order to keep the lights on. And it worked. After the initial shock to the economy, people had their stimulus checks to give them a little bit more time to figure out how to keep their lives going. Businesses were able to do the same. Everyone who survived with their health intact adjusted to the new world. Some for the better, some not so much. But it wasn't an economic meltdown. However, once the general sentiment began to turn in favor of being in a new normal, the trillions of dollars that were injected into the economy were still in the economy. Sure, the amount of goods and services is back up as well, but not nearly by the trillions of dollars that were created from thin air. People still had a little bit of cash lying around from their stimulus checks, and the people who participated in the Great Resignation presumably ended up with slightly bigger paychecks as well. Typically, new job means more money. Businesses that want to stay in business and be competitive usually try to maximize profit. The supply chain disruptions of the past couple of years have, of course, increased the price of certain goods, and passing those cost increases to the consumer is to be expected. The problem occurs when companies try to increase their prices way more than the added cost requires them to. Sure, it's okay if one place does it. It's not okay when other businesses look at that first business and go, hey, that guy's doing it, we can do it too. This leads to people needing more money overall to maintain their way of living. This results in those people trying to find jobs with higher pay. Staffing costs go up, which leads to higher prices again, and so on. Inflation. And we know what happens when it spirals out of control. We get Zimbabwe, we get the Weimar Republic, Venezuela, and so on. Among the various tools used to regulate the economy, the federal funds rate is probably the most well-known and most effective. Here's a brief description for those who are a little bit rusty in economics. The term federal funds rate refers to the target interest rate set by the Federal Open Market Committee, FOMC. This target is the rate at which commercial banks borrow and lend their excess reserves to each other overnight. The FOMC, which is the policy-making body of the Federal Reserve System, meets 8 times a year to set the target federal funds rate, which is part of its monetary policy. This is used to help promote economic growth. At its peak, inflation reached 9.1% in June of 2022 in the United States. In other words, the consumer price index was 9.1% higher in June of 2022 compared to June of 2021. For a modern, highly developed economy, this is pretty bad. For comparison, inflation was hovering somewhere between 0 and 2% in the 8 years preceding the pandemic. Time to bust out the corporate chill pill that is the federal funds rate and bump it until inflation goes down. And bust it out they did. In March of 2022, the interest rate was around 0.08%, aka near zero. By mid-December, that rate stood at 4.33%. The cost to borrow money became a thing again for businesses and for people. Not only does a much higher interest rate slow down corporate borrowing, it has also served to cool off an overly excited housing market that has made buying a first home even more out of reach for most younger people than ever before. Most people take out mortgages to finance their home purchase, and with higher interest rates, the amount of money they can borrow goes down within a fixed monthly payment. Property prices end up going down, and with it, so do the minimum down payments that people have to make. In the end, housing becomes a little bit more affordable overall. There are, of course, downsides to all this. Companies have to make tougher hiring decisions because money isn't as easy to borrow anymore. Trading activity goes down with margin rates being elevated. Car loans and mortgages are more expensive. The list goes on and on. In other words, the economy slows down. So now the question is whether it's worth the slowdown in order to curb inflation. The answer is obviously yes. Average people like you and me can't take a 9% hit to our purchasing power every single year. Had the federal funds rate remained near zero, that inflation number would probably be even higher than that. And when everyone's livelihood gets wiped out, despite all the hard work, despite all the blood, sweat, and tears, the end result is social unrest, and our overlords definitely don't want that, especially when their own bottom line starts to get destroyed by the black hole that is inflation. The goal, as the Federal Reserve has always maintained, is to keep inflation low without tanking the economy. But inflation is the greater evil compared to a recession. But will there be a recession? The short answer is we don't know. If you dig around the internet, you can find arguments supporting either side. But it is worth noting that the media is biased in favor of reporting fear, uncertainty, and doubt, aka FUD. Smash that like button if you don't let FUD define your personality and worldview. The not so short answer is that we have to look at some history in order to educate our guess. The last major meltdown before the pandemic was the 2007 and 8 financial crisis. Explaining that calamity would take hours, but the oversimplified version of it is that it was the result of predatory lending in an overzealous real estate market. After the storm was over, what followed was one of the longest bull markets in history. Regulations were put in place to ensure that that situation never happened again. Banks undergo regular testing to make sure that they can handle a crisis of that magnitude. The Federal Reserve implemented money policy that kept everything relatively stable all the way up to 2020 when the world faced an unprecedented challenge. In March of 2020, the stock market plummeted as if there had been a bubble. Many economies around the world printed their way out of this. The 1987 crash, also known as Black Monday, taught us that liquidity is essential to keeping markets and economies going, and injecting a shitload of money into the economy has been used as a tool ever since. This is, of course, supposed to be a short-term band-aid. If you do it too long, you end up with hyperinflation because money printer go brrr. In the year and a half following the initial shock, the stock market rallied an amount roughly equaling the amount that it tanked, but on the other side of the trend line. 2022 economics was defined by high inflation and the Federal Reserve trying to counter it by increasing interest rates. It did so 8 times. After the stock market reached a new peak towards the end of 2021, it then fell around 20 to 25% since, and we're still awaiting a proper recovery. Tech companies have been conducting massive layoffs. Analysts at financial institutions routinely made headlines claiming that we're going to see a further 25% drop in 2023. I think there's at least some degree of nonsense in all this doom and gloom. I realize the world is very different from how it was 3 years ago, but it doesn't feel like there is a recession, and the numbers back it up. Sure, the market has yet to begin a proper recovery, but zooming out a little bit, we see that where we are right now is roughly back to the long-term trend line, aka we're still fine, we're probably going up soon. Sure, interest rates are still going up and they're expected to peak sometime this year, but inflation looks like it's going back down to the normal range as well. Sure, there are layoffs, but those are adjustments based on overzealous hiring, based on expectations that everyone will continuously be adjusting to the pandemic way of life into infinity and beyond. So here's my proposal. Of course I could be wrong, and by the time I publish this video, maybe there's a huge financial crash. Whatever. What if 2023 is the year we return to a normal economy without any calamities? Despite rising interest rates, the United States is seeing unemployment at or near all-time lows. Corporate America just needs to retain its strength through the end of the inflation healing process. Perhaps the biggest day-to-day changes we're going to see as productive members of the workforce, outside of the layoffs that are going on, are the counterproductive cuts to working conditions. Stuff like cutting free food and, more importantly, coffee, forcing workers to go back into the office just because, and so on. I know I glossed over many details, but I try to tell 10 to 15 minute stories, not hour-long symposiums. I just watch those. The point is that within the rather condensed package of observations I've provided, I wanted to offer a take less dramatic than "we're all headed towards a depression," and more, what if the economy is doing exactly what we need it to and we're just seeing a protracted return to normal. That's it for this video. Do consider subscribing if you haven't done so already. And of course, thank you for watching.